Good evening, everyone. Welcome back to Boss Economic World, where we peel off the layers of financial jargon, toss out the noise, and get straight to the raw, unvarnished truth about your money. I'm your host, and today is November 25, 2025. If you looked at your portfolio on Monday, you probably thought your brokerage app was glitching. The Nasdaq 100 ripped higher by 2.6%, its best single day since May. The correction we were all sweating over last week? Corrected. Deleted. Forgotten. But here is the question nobody seems to be asking: why? Did Apple announce a phone that prints money? Did Nvidia discover a chip that runs on air? No. The tech giants were quiet. The news came from the most powerful, and arguably the most confused, building in Washington, the Federal Reserve. Today, we are going to dissect why bad news for the economy has suddenly become the best news for your stock portfolio, why Wall Street is betting the house on 2026, and why President Trump's 50% tariff on Brazil might have just handed President Lula and Brazilian investors the biggest win of the year. Grab your coffee, and let's dive in. Let's rewind to last Friday. The mood on Wall Street was grim. Stocks were selling off because the data suggested the economy was still too hot, implying the Federal Reserve would keep interest rates high. The odds of a rate cut in December were evaporating faster than a snowflake in a sauna. Then, over the weekend and into Monday, a strange phenomenon occurred. The Fed speak shifted. It wasn't a subtle shift, it was a U-turn. Governor Chris Waller, who many of you know is currently auditioning for the role of Fed chairman, went on Fox Business this Monday. Now, Waller is usually a hawk, he likes high rates to kill inflation. But suddenly, he's sounding very concerned about the labor market. He basically told the world, "I'm worried about jobs, and I'm open to a cut." He wasn't alone. Mary Daly from the San Francisco Fed told the Wall Street Journal she fears a non-linear fall in the labor market. In plain English? She's terrified that unemployment isn't just going to tick up, she thinks it might fall off a cliff. Then John Williams from the New York Fed chimed in, saying downside risks to employment have increased. Here is the truth: correlation doesn't prove causation, but in finance, perception is reality. As soon as these three heavyweights signaled they were scared of a recession, the futures market went berserk. The odds of a December rate cut shot from under 50% to over 70% in the blink of an eye. Why does this matter? Because the market has realized something crucial. The Federal Reserve is terrified of breaking something. We are seeing the resurrection of the Greenspan put. For those too young to remember the 90s, Alan Greenspan used to cut rates every time the stock market threw a tantrum. Traders now believe the current FOMC has their back. The logic is twisted but profitable. 1. If the economy weakens, the Fed cuts rates. 2. Rate cuts pump liquidity into the system. 3. Stocks go up. So, we are in a bad news is good news cycle. The market rallied 2.6% not because the economy is strong, but because the Fed admitted the economy might be cracking, promising cheap money to fix it. It is a dangerous game of chicken, but right now, the bulls are winning. Now, if you're a data nerd like me, you're probably asking, but boss, what about inflation? Isn't that still a problem? Here is the comedy of errors we are living in: we don't actually know. Thanks to the ongoing government shutdown drama in DC, the data tap has been turned off. The most recent reliable inflation report we have is from September. In financial terms, that is ancient history. We are trading on ghosts. The bond market, however, is voting with its wallet. Look at the break-evens, the difference between regular treasury bonds and inflation-protected bonds. They have dropped significantly in recent weeks. The market is effectively saying, inflation is dead. We won. This is where it gets risky. The market is assuming that the massive tariffs being thrown around by the Trump administration won't cause prices to spike. The gap between 1-year and 2-year inflation expectations has closed. Traders have convinced themselves that even if tariffs hit, the price hikes will be transitory. So, we have a market flying blind, assuming inflation is gone, and betting the Fed will cut rates to save jobs. It is a perfect recipe for an everything rally: stocks, bonds, crypto, gold. When you don't have data to contradict you, you can dream as big as you want. Let's talk about where this money is going. People are desperate to buy. If you look at the surveys coming out of Wall Street, the pessimism from earlier in 2025 has vanished. Bloomberg's survey of investment strategists shows they are already rolling over their targets to 2026. Historically, Wall Street strategists are like sheep. They follow the market price. If the S&P 500 goes up, they raise their targets to make it look like they predicted it. If it goes down, they lower them. But right now, the herd is stampeding uphill. A recent Bank of America securities survey shows that 57% of fund managers expect the S&P 500 to finish 2026 above 7,000. Considering we are currently sitting around 6,700, that is a bold, bullish call. You might think they are worried about a trade war, or the midterms, or AI failing to deliver profits. Nope. The number one fear listed in these surveys is a resurgence of inflation that forces the Fed to hike rates. That is the only thing that scares the bull. They aren't afraid of a recession. They aren't afraid of political chaos. They are only afraid of the Fed taking away the punch bowl. We cannot ignore the elephant in the server room: artificial intelligence. Is it a bubble? Probably. Valuations are stretched tighter than a drum. But look at Absolute Strategy Research's survey of asset allocators managing $9 trillion. They admit stocks are expensive. They admit valuations should contract. Yet, they are still buying. Why? Because corporate earnings are holding up. As long as Microsoft, Nvidia, and Google keep printing cash, the market will tolerate high prices. The belief is that we are in a Goldilocks scenario: inflation is slain, the Fed is friendly, and AI will revolutionize productivity. It is a beautiful narrative. Just remember, when everyone believes the same thing, that is usually when the rug gets pulled. But for now, the music is playing, and everyone is dancing. Now, let's pivot to one of the most fascinating economic battles of 2025, the United States versus Brazil. Or more specifically, Donald Trump versus Lula da Silva. If you've been to the grocery store lately, you know coffee and beef prices are up. You can thank the trade war for that. Back in August, the Trump administration slapped a 50% tariff on Brazilian imports. The political goal was clear: pressure President Lula regarding the legal treatment of former President Jair Bolsonaro, who is currently sitting in a jail cell after the Brazilian Supreme Court ruled him a flight risk. The logic was that if we squeeze Brazil's economy, Lula will cave and release Bolsonaro. The result? A spectacular backfire. It took about 4 months, but Washington has tacitly admitted defeat. Why? 1. The U.S. consumer got punched. The U.S. imports commodities from Brazil that we simply cannot source domestically in sufficient quantities. Brazil is the world's leading supplier of beef and coffee. When you slap a 50% tax on those, American voters pay the price at the checkout line. Trump realized that asking Americans to pay $8 for a latte to help Bolsonaro wasn't a winning political strategy for the midterms. 2. The Brazilian market exploded. The assumption was that tariffs would crush the Brazilian stock market. The opposite happened. Since the panic in April, the Brazilian benchmark Ibovespa index has soared nearly 48% this year in dollar terms. Let that sink in. Brazil is beating the S&P 500. It is beating almost every other emerging market. It wasn't just luck. It was brutal, effective monetary policy. While the US Fed dithered, the Banco Central do Brasil went into beast mode. Under President Gabriel Galípolo, they hiked the benchmark Selic rate repeatedly. It currently stands at 15%. When you offer investors a 15% yield, they tend to forgive a lot of political noise. Bloomberg economics models show that while US macro shocks hurt Brazil, the credibility of their central bank outweighed the damage. The high rates crushed domestic inflation expectations and attracted a flood of foreign capital looking for yield. The Brazilian real, which was in freefall earlier this year, has stabilized. In fact, it's rallying back toward its 100-day moving average. By waging a trade war, the US inadvertently strengthened Brazil's economic discipline. Brazil's 5-year interest rates have actually declined from 15.5% to 13.2% because the market trusts Galípolo so much. They know he will do whatever it takes to kill inflation. Meanwhile, Lula is sitting pretty. The economy is surviving the tariffs, his stock market is at record highs, and he didn't have to cave on the Bolsonaro issue. The latest consensus is that Brazil's rates won't even start to ease until late 2026. They have built a fortress of high interest rates, and it turns out, the fortress is tariff-proof. So, what is the full picture for you, the investor, on this chilly November Tuesday? We are living in a world of contradictions. We have a US stock market rallying on the fear of a labor market collapse, betting that the Fed will save the day with rate cuts. We have an inflation narrative that assumes mission accomplished despite a total lack of government data to prove it. We have a trade war that managed to make your groceries more expensive while simultaneously making Brazilian investors rich. Here is the truth: the market is currently running on pure liquidity and hope. The Fed put is the most powerful drug in finance, and right now, Wall Street is high on it. The expectation of cheap money in December is overriding the reality of a slowing economy and geopolitical friction. Don't fight the trend, but don't ignore the cliff. If the S&P is heading to 7,000, enjoy the ride. But keep an eye on that non-linear drop in the labor market Mary Daly is worried about. If the economy slows down too fast, no amount of rate cuts will stop earnings from falling. And as for Brazil? It's a reminder that in economics, the obvious outcome is rarely the right one. Tariffs are taxes, and usually, the country imposing them ends up paying the bill. If you want to hedge against US inflation, maybe it's time to look at the country that sells us our coffee. I'm the boss, and that's the economic truth. See you next time.